Okay, great, you're incorporated. Meet your new accountant, all right? No need to be certified to call yourself an accountant. I can call myself an accountant. I would have loved to have printed business cards that I could hold up that say Dustin Woodhouse Accountant. This is craziness. Realtors own the word realtor, and I don't want to disrespect realtors. I think they have an increasingly difficult role. They are a professional group of people. I mean, it's not straightforward, you know, paint by numbers work. A lot of those contracts, there's a lot of complexity in there. So all due respect to realtors, and they own the word realtor. How have accountants failed to take ownership of that word accountant? How can just anyone, me, call themselves an accountant? How is that allowed? This is the weirdest thing. By the way, the same also applies to financial planners. Anyone can call themselves a financial planner. So for the purposes of this next segment, I will be both your accountant and your financial planner. Not certified, not chartered, but I can still call myself those things, and that's just wrong. Somebody who regulates such things should fix that. But let's get to the real heart of the matter. Paycheck 101. If you're a sole proprietor, your option is T4 only. That's it. That's how you report your income as a sole proprietor, and that's awful. If you're incorporated, you could T4 yourself. You can, but no, don't ever do this. This is not a good idea. It's not a good idea. I already know what some of you are saying and you're thinking, but we'll get to that. Don't worry. It's just, trust me, it's not a good idea. If you're incorporated, you can pay yourself via dividends. Yes. Dividends are great. Always draw the dividend. And don't take $0 out of your corporation ever. Yes, I've had that mortgage applicant with an NOA that said 0 on it for like 3 years in a row. He took shareholder loan repayments instead of income. That is such a waste. You pay so little tax on the first 50, 70 grand. You pay no tax on the first 30, basically. Why would you not take 30 as income and defer the shareholder loan repayment a few years further down the road? When I mapped that out for him, he was like, well, why didn't my accountant tell me that? And we got to the bottom of it. Because his accountant wasn't an accountant. That's why. So draw out a real dividend. 70,000, 90,000, 128,000 sort of maximum if you can keep it there. But draw something real out. That's very important. So remember, T4, bad. T4, no. Dividend, good. Dividend's good. Especially when you consider that you're business for self. You. And what does that mean when you want to get a mortgage? What does that mean when you want to start building your rental property portfolio? It means that you may need a stated income program, right? You may need a stated income program. And stated income programs, if you're self-employed and you're T4ing yourself, you're out of luck. So keep in mind what you actually do for a living as well. It all weaves together in this. So we're mainly going to focus on the Ontario residents. And I use the Wealth Simple Tax Calculator for all these calculations. So hopefully they all line up. So I've used 62.5. As a sole proprietor, you're not incorporated, you made 62.5. So you closed, let's say, 8 million in volume, you got 62.5 in pay. Life feels okay, but you know you can do better. You paid $527 a month, $6,333 in CPP. Now, I hate to break it to you, but dudes, and I'm talking to you, men, you're never, ever gonna get that money back. You're just not. Statistically speaking, you will not live long enough to get the money back from CPP that you've put into CPP. So being a sole prop and having to pay the full pop of CPP, that really kind of sucks a lot. So dudes, I hate to break it to you, but you're never gonna break even on CPP. You will never get back the amount of money you put in. You really won't when I show you some additional math coming up. But if you made that 62.5, you paid $16,700 in taxes, you netted out $45,000. Had you been incorporated and taken a dividend, the dividend would only need to have been $49,200 because you only pay $3,400 in taxes. and you net out the same amount of money. So you've drawn less money out of the corp, and you've netted the same amount of money. Where's that other money? Well, that other money, that 13.3 that left in the corp, you do have to pay corporate taxes on, 11% typically. So you've got $6,425 worth of new money, except not really, because what that really is, that's the $6,333 you didn't pay in CPP. So you do have $6,400 in cash in your corporate account that you wouldn't have had otherwise, because you would have paid the government the CPP, the employer and the employee contributions. But now you've got that money in your hands, and we'll come back to what that could mean for you. But that alone is pretty significant. You know, as I say, it's technically your CPP contribution. But at 62.5, I'm just going to suggest, if you're a single parent in particular out there, heck, if you're just anybody out there in the world right now, 62.5, increasing your cash flow by $6,400, by $530 a month, that's a big deal. Like, that's a big, big deal. That's very, very helpful. And yeah, you'd be spending your future CPP, but we'll come back to that. And what about growth? What's your plan for 2022? Are you not planning for success? Are you not planning for awesomeness? Are you not planning to do more? Right? 5 million more, 10 million more, 20 million. What if that just happens? I mean, I've given you the median numbers, an $11 million to $21.7 million jump over 2 years. Did all those people get incorporated? Nah, they didn't. They're gonna get hit with tax bills that are just gonna make them puke. We're gonna put those numbers up here, and they're gonna see what kind of tax bills they're gonna get hit with. And it's, well, make sure you got a box of tissues close by. All right, here we go. Basic math, $100,000 income, sole proprietor. We're gonna move up the income chart a little bit here. 28.5 in taxes, 71.5 net. Incorporated, you only gotta draw an $82,000 dividend out of that 100 grand. You pay 10.5 in taxes to have that same net amount in your personal bank account. And it's all about the division. It's about having this corporate bank account over here, your personal account over here, and that division is huge. Now you've got $18,000 sitting over here. Now you gotta pay $11,000 in corporate taxes, but you have $7,000 in new money. You're like, Woodhouse, I'm up 666 bucks. Like, that's it. Like with this incorporating thing, I still got the 6333. You know, I got to put that away. I got to save it because it's supposed to be CPP. You're right, but you're not. So let's get there. We'll get there. On $100,000 of Inc., you've increased your cash flow by $7,000. Keep that in mind. That's not nothing. So again, leveling up a notch, $200,000, because you suddenly had that breakout year. You went from 11 million to 21.7. Whoa, look at that. You've got an extra $100,000 of income. And by the way, when it hits your personal account, what does that do to you? It makes you feel pretty good, pretty wealthy, because there's no tax coming off that. So you're feeling really good. I wasn't even gonna talk about the tax trap, but the tax trap, it's real. And I've been there, and you don't ever wanna go there, because you suddenly feel wealthy. It's like those commercials, you're wealthier than you think. Yeah, I am. Man, I am killing it. My bank account is just piling up with fat stacks. I'm going to the club, I'm gonna make it rain, I'm gonna pick up a new ride, I'm gonna get some new duds. Everything's amazing, and then the tax man comes and says, we need some money from you. And it's cool because you're already into the spring market and you just pay them with next year's money. But that catches up with you eventually. So there's the tax trap. The problem though is that money hitting your personal account, it's read in your brain differently. The signals are different. My corporation account is over there. And there's a bunch of money that's showing up there just in the last month, heck, just in the last week. All that money's showing up over there. But I'm not looking at new dirt bikes or whatever, or maybe like the new suit that I probably need. I'm not looking at any of that stuff because that money's over there. It's in the corp and it's for business use. What can the business do to continue furthering the business's purposes? So there's a division there that's very, very important. Anyway, you've got 126 grand after taxes. By the way, I hope you're connecting the dots. On 200 grand as a sole prop, you're paying 74 grand in taxes. You remember before the break, I told you what I paid in taxes on 668, right? Yeah, so you've got 126, good stuff. Basic math though, $170,000 dividend, 44 grand in taxes, puts that same 126 net in your hands. And this is a number that I think, if you can't find a way to live comfortably on, 10-5 cash on a monthly basis, we got something we got to talk about there. There's some problems there somewhere. So 30K in returned earnings, 22K in corporate taxes, 8K in new money. Okay, but you're still mentally subtracting that CPP off, and you're thinking, so I make 200 grand, I got $1,700 extra? No. There's a lot more to it. Stick with me, we'll get to it. $200,000 sole prop, 74 in tax, net 126. I feel like, yeah, there we go. There's a reason I repeated that slide. 126, that's $54,000 in new money. So when you hit that $200,000 mark, you earned that extra $100,000. The difference between making 100 and 200 after tax was $54,000. $54,000 of new dollars in your personal account. In your personal account, the last place you want that money. That means kitchen, clothes, dinner out, nice bottle of wine, vacation, sorry, one day. It means a lot of things are gonna get purchased because you feel wealthy, but you could be so much better off. Now, what if you could live on 71.5? What if you could just keep living like you still were at that $12 million production level, not at the $22 million production level? What would that look like? $200,000 sole prop, 74 in taxes, 126 net, okay? I'm repeating the slide for a reason. $82,000 dividend, 10.5 grand in tax, 71.5K net. $118,000 retained, $22,000 in corporate taxes, $96,000 in new money. I feel like I need to just back up a little and give that to you one more time. So if you're a sole prop and you made your 200 grand, you got your 126 net, it's done. You're paying 74 grand in taxes, period, the end. There's your 126. Be a good consumer, get out there and spend it. That's what they, if there is a they, I don't believe there's a they, but that's what they want. They want you to spend that money. Stay on that hedonic treadmill. Stay on that hedonic treadmill. But if you said, no, I'm gonna live like I only made 100 and I'm incorporated, so I'm just gonna take an $82,000 dividend. I'm still just gonna live like I did last year on that 71.5 after taxes. We're just gonna pump the brakes on the reno. We're gonna drive the car for another year. We're just gonna take it easy. What does that look like? As I say, $96,000 of new money sitting in your corporate account. Sole prop, 126 cash. Inc., 167 cash. The incorporated individual has the ability to live their life like they earned the same amount the year before. The sole prop has no such flexibility. You're stuck. You're forced to pay full tax on every penny you make, no matter how much money you make. You have control over your income, taxes, how much you wind up drawing, how much you wind up paying when you're incorporated. You can leave the money in the corp. And by the way, you don't get double taxed. It's tax neutrality. There's a word I'm looking for. I should have pulled it up before the presentation. My apologies. You don't get double taxed. You pay the corporate tax, and then when you draw the money out personally, that's accounted for. So you're not paying any extra tax a year later when you take it out. That's an American phenomenon, not a Canadian phenomenon. So you've got that extra $40,000 in cash as a corporation year after year after year. What do you think that looks like invested prudently, compounding over time? It's massive, massive. If you're 23 years old and you're listening to this right now, I was 19 when I got incorporated, right? You're never too young to get incorporated. There isn't an age that you get incorporated at. It's about planning for the future success you know you're going to have. This decision to incorporate and to draw less money out than you need to draw out to have the ability to do this can absolutely change the course of your life. It is a game changer, absolute game changer. $500,000 sole proprietor. I know you're watching. I know you're watching right now. We've had the conversation over the past 4 years. And again, you've ended 2021 and you made $500,000. I really am talking to an actual person. I'm not going to name them. $500,000. Dude, just like sit down and like lean back and get ready because this is going to hurt. This is really going to hurt, especially when you've given how many years this has gone on for. As a sole prop, $234,000 of those $500,000 will leave your life forever. Gone. That's it. $266 is what you're left with. How the hell are you going to get by on that? I mean, it's not really a living, but it's a start. I'm completely kidding. I'm totally joking. That's phenomenal. That's incredible. You're in the top 1% of earners in the country. That's fantastic. Good for you. $266,000 net, that's awesome. Pat yourself on the back, turn the computer off, go away now, because this is going to hurt. $170,000 dividend paid out, be $44,000 in taxes and $126,000 net, right? Can you survive on $10,500 per month after tax? I'm pretty sure the gentleman I was speaking to can. I'm pretty sure that would work. $330,000 would then be retained. $55,000 in taxes paid on the $500,000. There would be $275,000 of cash left inside that corporation. Now, we took less out to live on, but the sole proprietor has $266,000 cash, period, the end, no options. The incorporated individual who says to themselves, yes, I can somehow get by on $10,500 cash in hand every month, they have $400,000 in their corporation to do something with. $134,000 flowing to the tax man or controlled inside your corporation to do with what you wish. It's the government's money. They're going to get it in the end. It's all good. They're going to get it in the end. But they're basically saying, you can keep it for now. What would you like to do? Now, I forget what slide comes up next, but I'm just going to pause right there, and I'm going to say that for 5 years in a row, that individual could have purchased a $500,000 property. That individual could now own $2.5 million worth of real estate that they would have had 20% down, so they have $500,000 in equity. Plus, you look at the pop, that 2.5 mil would probably be worth 3.5. They'd be up $500 or $1 million in the lift. They'd have those properties tenanted with tenants paying the interest, taxes, and strata. Even if they weren't positive cash flow, it wouldn't matter. They're still being paid to wait. The exponential growth over time, the compounding effect is incredible, year after year after year. Can you start to see why I get so passionate about this topic? It kills me to see people given this gift of being able to incorporate and then not doing it. What is wrong with you? And I know it's not you, it's your accountant. We'll talk about that. But right now, I'm your accountant, so listen to me. To ink or not to ink, like, need I go on? Like, that's it. Like, we're done.